The S&P is at a critical juncture. This trend line continues to be respected, but this time we're seeing some data that is a little different. We also have the 200 SMA that is right there again, which was another sign of rejection. But if we take a look at what happened August 16th, it's becoming increasingly clear that this time you have some underlying fundamentals that are very different. We have the PMI, which is plummeting, which shows manufacturing and where we are. Now, what's important about this is a great tell, and we're going to get into that in a second. We have the unemployment rate people think is guaranteed to go back up, and there's a couple reasons why that may not be the case. We have the yield curve inverting, all of these events, and we're going to talk about why this may not actually be a bad thing. You can see the trend lines being respected here very clearly. We're on a monthly chart. Now, if you flip over to the daily and you zoom in, you can see what we've been dealing with in the carnage. The question is, why would this time be a little bit different? We're going to have to see if it is or if it isn't, but there's some signs here that are, to me, pretty glaring. During economic cycles, when they shift, you get a changing of the guard. Usually a sector peaks in the S&P around 25%. That's exactly what we've seen happen here. Now you can see these three spikes down and then we hold. We zoom out on this, and this is really technology, information technology, which is 25% of the index divided by the SPY, which gives us a relative number. That's how I calculated this chart out. And I do appreciate your comments. If you were to look at this, you would see a left shoulder, a head, a right shoulder. So now we have the major sector of the S&P rolling over. Why is that a good thing? Every economic cycle, when you shift, you're coming out of a period of contraction or being overheated. And when that happens, you shift who your leaders are. It happened in 2000, happened in 2008. We're going on the assumption that tech is going to be the leader. Maybe it is, maybe it isn't. This is the industrial space versus the SPY. Relative, we can see that we're actually setting up here on industrials to break out. We're actually setting up a little bit of a cup and a flag here for the industrials to start outperforming. So we can find different leadership, and that's usually what happens when you come out of, whether we call this a bear market, a correction, does not really matter what we call it. But when you're setting up like this, you need to pay attention and you need to start focusing on how these sectors are acting. This is the financial sector versus the S&P. This is extremely important for people to get. Why? Very rarely do we have any kind of sustainable rally in the S&P unless financials participate. Why we undergo a changing of the guard? We want to watch the financials and we want to see if they start outperforming. So we're going to want to pay attention to this. One of the second largest sectors out there is consumer discretionary, retail. People may look at this and then be a little concerned and say, well, we're going to underperform. I would argue that by looking at this, you can see when you hit trough levels. In other words, when do you hit a level where the underperformance simply stops and cannot go any further? And I would suggest that we're possibly there. So now we have other sectors that are breaking out. The leading sector is finally cracking, so money is moving out of that and it's being diversified into other sectors. If you want to sustain the rally, you need breadth. That means more sectors. That is very different than what was happening here in August. And that's what we're all watching. We're all watching this August 16th level because this is when we got to the 200-day moving average, and it's also when we flip. This is the unemployment rate. This is what everybody is somewhat concerned about. They're concerned about where the unemployment rate is and how is this possibly sustainable in this kind of market. Therefore, earnings have to come in. I would argue that if you look at this level, there is some validity to that statement, but we've been down here already for a period of time, already baked in that we are expecting this to come out. Now, if we focus, you can see going back 50s or the 60s, and you can see that this level in here is pretty substantial. This is a level that we've seen hold, and it's definitely one that I don't see why it's not going to hang in here again. You crack it for a little bit, and then you head back up. But this is where you're going to wind up heading to, something around here. I don't think that's going to be the absolute end of the world when everybody is this employed. Are we going to see people start being laid off a little bit more? Sadly, the answer to that is yes. Now, we're looking for a peak in inflation in order to signify a bottom. That's what everyone usually looks for. Peak is relative. Here you have a peak and you can see the bottom. Here's another bottom. and here's your peak. See how the peak keeps going up and up and up, and the bottom is where the bottom is? This is a relative way to look at the index and use as a signal. I don't know where the peak is on here. We don't know if that's a 4% number, a 5% number. We're really not aware of what that peak is going to look like. If it's going to look like something that happened in '02, which is really the level that you were at before, and this market's acting exactly like 2001. Now, Chicago PMI that came out last week, you have PMI coming out this week. People will be watching this. In August, when we were at the same level, we were roughly at 52 on Chicago's PMI. We are at 37. We take the blue line and we mark off the current level at 37, and then we denote in black arrows what's happened there. Every single time that it's been a trough. Now, here was an example of where it went up and then rolled back down again before taking off. This pattern's actually defined in a book. It's called The Hedge Fund Edge, and it actually talks about when PMI gets under 40 that you should be actually looking at increasing your exposure to the equity market. This is the S&P stocks percentage above the 50 place last time, where we did wind up coming in. So we need to be aware of this, that it is possible for that to happen. But longer term, we're getting a much different picture. Below, we can see that this is the S&P stocks percentage above the 200-day, which shows an increase in breadth. And we can see that we're actually making more stocks over the 200-day than are over here in August. Pretty good signal that we have better breadth in the market. Now, this graph shows the US yield curve and the financial crisis that happened. And it shows when we have a negative yield curve, which you're hearing a ton of talk about and how negative that is. And I just want to point out a couple dates. So here you are during the pandemic, Lehman Brothers debacle, Russia in 1998, the dot-com bubble in 2001, 2002. The dates of those inverted yield curves is marked right here. So if you were to look at those dates, should you be a buyer or a seller of equities at that? You would want to be a buyer. This is the bull-bear ratio going back years. What's important about this ratio to me, it gives you the sentiment. In other words, how do people feel about the market? Are they bullish or are they bearish? If you look right here, you'll see that we are more bullish August with less breadth than we are at this particular time. Those two dates on that chart are marked here and here. We know a couple things. We know that the masses are usually wrong, and this is where the masses are selling. We know the masses are more negative here than they were here. We know the breadth of the market is stronger here. We know that PMI has a much stronger reading for a bounce than it's had all year long. So we have a lot of factors that are in our favor. We obviously have to see how this is going to play out, but I think that this was worth noting. The trading community is on waitlist. If you are interested in joining the waitlist, simply click the link up here. It also, while you're on the waitlist, you will get a copy of the periodic free newsletters with updates and alerts about what's going on in the market. Try not to be retail out there. Try to make good, smart decisions. And remember, if you're going to get through this, you're going to be able to get through anything. Trade to win.